In this video, I am going to analyze companies which are into mining, mineral, metal sector like Coal India, Vedanta, NMDC, Maithan Alloys and Indian Metals or IMFA. We are going to look at around more than 60 ratios. Now all these ratios are basically in numbers, and it may be boring for majority who are looking at this video or who have started this video, and it may be not interesting as well. Let me say that upfront. I'm making this video for myself, for comparing these companies so that I can invest in the best companies by looking at these ratios. Now, if you are investing a lakh or 2 lakh or even more, I feel that we should at least give an hour or two and understand the company, how it is performing, where the price is compared to different variables like earnings, cash, book value, sales, and so on. And we have to also look at how the sales are growing, how the profits are growing, and is the company paying dividend? What is the promoter holding? If the promoters have pledged anything, we have to look at that. What is their debt? Is their debt very high? And if it is high, are they able to pay off the interest with the profits that they are earning? Whatever profits they are earning, is that getting converted into cash, into their bank account? Is it coming into their bank account? These things are the very basic that we as investors need to understand, and these ratios helps us to do that. But it takes time. There are 5 companies that I have to analyze. There are 60 ratios that I have to go through. This video will be a long one, maybe an hour or more than that. Feel free to skip to any part because there are 60 ratios. I'm sure not many people would want to go through all of them. But if you're seriously interested in investing any of them, do look at these numbers. Try to understand them. Most of these numbers are in terms of percentage or ratios. With the percentage, what we understand is what portion of something is of some other value. So for example, if I say that on a price of 255, the company has earned 28 rupees. So how much percentage was it? So when we put down all the variables to a percentage, bring all of them to a value of 100, comparing it with 100, then we get an idea as to how the group companies have behaved. Now, all these numbers are sourced from screener.in website, and I have integrated them in Excel sheet. Investors can arrange these ratios in Screener. There are many YouTube video tutorials on how to put these ratios in screener.in, and then you can look at this video, try to understand how to analyze these numbers, and then maybe you don't need to look at these videos. You can look at these screener ratios themselves. By itself, it will show you whether this company is good. Now, we have to ask many questions when we start looking at these ratios. Why? If they are high, why they are high? If it's low, why is it low? Is that a problem? Is that a red flag? And so on. There are many questions that will keep coming up in this video. And I'll keep asking these questions. So this is kind of a tutorial video as well as an analysis video for Coal India, Vedanta, and companies in the mining, mineral, metal sector. So let us begin this video with Coal India's current market price. It stands at 255 rupees per share. And the price currently is down by 14% from its 52 weeks high. That is the past highest value. From there, it has fallen by 14%. We want to buy into stocks when they are down from their 52 weeks high. The more the fall, the better it is, provided this fall is not due to an inherent problem in the company itself. The fall has to be sector-wide or group-wide, and it should not be specific to this company. So we want a fall. We want to buy when the prices are falling and keep accumulating gradually over a period of time till we exhaust whatever we wanted to invest, and then patiently wait out the time period that we need to wait. And then as the price goes up, the cycle turns, the company turns profitable, or the news are better for the company, then the price will go up, and then we again gradually move out of the stock by selling them at a slow pace as it keeps moving up and up. So Coal India is down by 14% from its 52 weeks high. Vedanta is down by 31%. The highest percentage fall was Indian Metals, which fell 50% from its 52 weeks high, where it was 52 weeks back. Now, we have to ask a question. If a stock has fallen of the group companies, Indian Metals has fallen 50%. Why has it fallen 50%? This is the first question we have to ask. And the lowest fall was in Maithan Alloys. So the lower it falls, the better it is. The more it falls, the worse it is. But provided that the fall is along with bad fundamentals, then we don't buy that stock. Let us look at the third ratio, which is the earnings per share or profit per share earned in the last 12 months or in the last 4 quarters. In the last 4 quarters, Coal India earned 28 rupees for every share, whose price was 255 rupees, which works out to an earnings yield of 11%. That is, on 255 rupees, the company earned a profit of 28 rupees. Vedanta also earned an yield of 11%. The highest yield was of Maithan Alloys, which managed an earnings yield of 14%. That is, on 608 rupees, it earned 87 as profit per share. The lowest earning yield is of Indian Metals, and the highest yield was by Maithan Alloys. Let us look at the price earnings multiple of the last 12 months. That is, what or where the price was compared to the earnings of the last 12 months. The last 12 months price earnings was at 9 times. That is, the investors were willing to pay 9 times more than the earnings of the company. And the earnings of the company was 28 rupees per share, and investors were willing to pay 9 times more than this earnings of 28 rupees to buy the shares at 255 rupees. This is how we have to understand the price earning multiple. Now, we as investors want to buy at the lowest price earnings multiple as much as possible. The higher the multiple, the more expensive the stock is. It could be also other way around for more other investors, in the sense that when the price earning multiple falls, people may find that the stock is not of good value, That is why the price is falling, or maybe the earnings are falling and the price is also fallen along with it. So the price earnings multiple will also fall. And vice versa. That is, if the price earning multiple is high, then it's a good stock. But as we can see here in Indian Metals, the price earnings multiple, that is, price is 46 times higher. Price is 46 times higher than the earnings of 4 rupees. So what has happened in this particular company is that the earnings per share has fallen to 4 rupee per share, but the price has not fallen accordingly. Therefore, the earnings or price to earnings is 46 times. Now what happens is, if the earnings drop but the price doesn't fall at the same time, then the price earnings multiple shoot up. So this is not a good value to look at. Next, let us look at the last year's price and earnings multiple. This is of 2018 year. Coal India in 2018 was trading 32 times higher than its earnings. The latest earnings to price comparison has fallen by 9 times only. In the last 5 years, historically on average, Coal India was trading at 21 times, whereas in the last 3 years, the price earning multiples were 25 times. So these are high price earning multiples. We have to wait for it to fall below 25 times. Many people even want to make it fall below 15 times. They wait till it falls below 15 times. Currently it is available at only 9 times its earnings at the last 12 months earning data. Comparing it with other group companies, in 2018 the highest price earning multiple was of Coal India, and Indian Metals was available at the lowest price earning multiple of 2.75 times. Historically also, if we notice, Coal India has been very expensive for both 5 years and 3 years historical price earning, and the lowest price earning multiple was of Maithan Alloys at 5.2 times historically price earning for 5 years, and 3 years historical price earning at 6.14 times. So as far as the latest price earning is concerned, Maithan Alloys is available at the lowest price earning multiple, and Indian Metals has become very expensive from its previous price earning to 46 times, because the earnings has fallen but the price has remained or has not fallen as fast as the earnings. Let us next check the current market price to the operating cash flow. Coal India's price to cash comparison or multiple is 7.4 times. That is, investors will have to pay 7.4 times more for the company's cash earnings if they want to buy this share. Now this is a very reasonable price to cash. We have to compare it with the group companies and see how Coal India compares with the other companies. Now what is the OCF? OCF stands for operating cash flow. That is the cash that has flown into the company or gone out of the company through business operations. That is considered as the operating cash flow. Now we consider or we compare the cash per share with the price, whereas in the price to earnings comparison we compare the earnings per share, that is all net earnings of the company per share with the price. Now this OCF only considers cash income and cash expenses coming into the business or going out of the business through its business operations. It does not consider non-cash expenses or incomes. like depreciation, credit purchases and so on. So in terms of cash, we are getting it only at 7.4 times, so which is a good sign. Vedanta is available at 3.4 times its cash. NMDC is available at 9.7 times, the highest. And Maithan Alloys at 6.2 and Indian Metals is just 1.7 times. Now this price to cash comparison uses the current price but the OCF value of 2018. So the cheapest one available is Indian Metals at 1.72 times its cash earnings, and NMDC is available at 9.7 times its cash earnings. So most of these companies have earned good cash when compared to its earnings. Or we can also say that the earnings has got translated into cash. Let us look at the price to free cash flow. Free cash flow considers only cash income and cash expenses that are spent or received from the operations of the business as well as investment activity that the company undertakes. So when we compare the price with the free cash flow per share, we see that we have to pay 12.35 times more for Coal India, and for the other group companies, Vedanta, it was available at 5.8 times the FCF. NMDC was the highest at 24 times its free cash flow. Here too we want all these ratios below 25 times at least, and if they are all below 25 times, then we have to compare and see which one is available at the lowest price earning or price cash multiple or price to free cash flow multiples. So in terms of price to operating cash flow, we see that Indian Metals has done best, whereas even free cash flow, it is only available at 2.82 times. NMDC is the most expensive, where the investors would have to pay 9.7 times its operating cash flow and 24 times its free cash flow. So what this signifies is that the company doesn't have a very high amount of free cash flow once it does its operations and its investment activity in cash. Let us look at the price to book value. The book value stands for the net worth per share, that is how much the share is actually worth if the company pays off all its liabilities and whatever remains goes or gets distributed to the shareholders. That's the book value or the net worth per share. Now we want to compare what is the actual value as per the company's records for each share and what is going or what it is trading in the market for. Coal India is trading at a high multiple of 5.9 times its book value, whereas other peer group companies are trading below 1.5 times. So Coal India is very expensive at 5.9 times, and here too our upper limit is 2.5 times. When we are looking for comparison with the book value, as investors we should try to buy below 2.5 times. Now we can also say that although Indian Metals is available at just 0.44 times its book value, that is, the shares are available at a discount to its actual value, that does not necessarily mean that this is a good bargain. We have to look at the growth rates, the sales growth, the profit growth and other ratios, and then come to a conclusion whether this price to book is justified or not. People in the market don't think the share's actual worth is what the company is saying. Therefore, they have brought the share's price below its market price or its book value. Let us look at where the price is compared to sales per share. This sales value is of the latest 12 months. Now, this particular ratio helps us understand how well the company has managed to increase its sales when compared to the market cap or the market capitalization of the company. So here what we are doing is we are comparing the sales, total sales of the company or sales per share of the company with the price per share of the company. So in this case, the price was 1.58 times higher than the sales. What we want to again look here is that the price to sales multiple should be as low as possible. That is, sales should be almost as good as what the company's market cap is. This suggests to us that the company's sales are at a high volume. So Coal India's price to sales multiple was 1.5 times, meaning total market cap was 1.58 times higher than the sales. Vedanta's sales was more here. Sales was more than the total price. NMDC's total market cap was 2.7 times higher than the sales of that year of 2019 March. Maithan Alloys sales were more than the price. And Indian Metals price or market cap has fallen below its sales, meaning they have done more sales than what it has in market capitalization, or what the entire market has given a value to the company. So the lower the better. So as far as the valuation wise it is concerned, Maithan Alloys and Indian Metals have done the best, where the price and earnings multiple or price and free cash flow or operating cash flow or book value or even sales is the best available for Indian Metals or IMFA. Let us look at the profit growth of the company from 5 years and how the profit has grown from 3 years back. For Coal India, the profit has fallen at the rate of 16% from 5 years. From past 5 years, the profit has fallen at the rate of 16.5%. Whereas from past 3 years, the profit is falling at the rate of 20%. Here, investors should look for a positive growth. What this particular number signifies is that as an example, if we had done a sales from 5 years back of 100 CR, then today anyone would expect us to perform better than what we performed 5 years back. But for Coal India, the sales has been falling continuously from 5 years. On an average, this is a compounded fall or compounded growth rate in fall of 16% and 20%. As I mentioned earlier, we need to see a positive value, and a growth rate of at least 10% and above is what we want to look at. Vedanta's profit, when compared with Coal India, has been growing at a high rate of 26% and 58% from 3 years back as well as from past 5 years. NMDC is just like Coal India, where its profit has been falling from past 5 years and past 3 years at the rate of 10% and 17%. Now looking at all these ratios is very important. This helps us understand how the company has performed when compared to peer group or when compared to its own ratios or other ratios. And it gives us a fair idea where the company is going. Maithan Alloys and Indian Metals both have managed to grow their profits over a period of 5 years and over a period of 3 years at a high growth rate. Profit growth for Maithan Alloys was very good from past 5 years, and since last 3 years, Indian Metals is growing its profit at a very healthy rate of 144%. Whereas Coal India has performed the worst at a profit fall of 16% and 20%. Let us look at the PEG ratios or the price earning to growth ratios, that is profit growth ratios. This particular ratio, price earning to growth ratio, helps us understand that what multiple we are paying for the company's stock. Are we getting or is that justified? So when we are paying 9 times, we also want to understand, first of all, we are paying 9 times the earnings. So what we want to understand is, will the earnings keep growing? So the way to understand that is to look at the profit growth rate of last 5 years. That this is the past data or lagging data. So but this particular growth rate is an estimate that we can project into the future to come to a conclusion as to how the profit will grow and whether this price earning multiple we have paid, if it's justified. So when we are paying 9 times the earnings, we want the earnings to grow. If the earnings doesn't grow, then it will take us 9 years to recover our capital that we have invested in the company. Now in this case, we saw that the profit even from last 5 years has been falling at the rate of 16%. Instead of growing, it's falling. Even since last 3 years, the profit is falling. So when we see this kind of situation, then even 9 times becomes very expensive to buy into the company. So the PG is calculated by dividing the price earning of 9.07 by minus 16 of the profit growth of last 5 years and by minus 20 to get the profit growth of last 3 years. We see a negative PG, which is not a good sign. Also, the PG ratio should be above 0 but below 1.5 times. Many investors look for a ratio between 0 and 1 times because they are more conservative. So they feel that 0 to 1 is justified. As we can see, for Vedanta, the price earning the PEG ratios are very good. That is, the price earning multiple we paid was 8.9 times. But we are getting a very high growth rate in profits of 26% and 58% from last 3 years and last 5 years. So this we project into the future to understand how fast we can recover our capital. So PEG ratio is below 1.5 times and above 0. So the nearer it is to 0, the better it is. So as investors, we want to see a PEG ratios of this kind. NMDC again has a negative PEG, which again would mean that there was a degrowth in profit. So even if we are paying 7.29 times its price earning multiple, we are still paying a high price earning. So only when we see a growth in profit, that is where this price earning multiple is justified. For Maithan Alloys, the price earning multiple is again very good. We are paying 6.9 times for the earnings and we are getting a high growth rate in that earnings of 46% and 78%, which translates to a very low PEG ratio. For Indian Metals, we are paying 46 times current price earning multiple and we are getting a PEG of 1.8, which is still higher than 1.5, but it's okay. So for a 46 multiple for the earnings we are getting a profit growth rate at the rate of 24% from 5 years. Whereas in the last 3 years, the profit growth rate was much faster at 144%. So the PEG ratio becomes okay here. So when we look at the PEG ratio, Maithan Alloys has performed the best, having the lowest PEG for both 5 years and last 3 years. Coal India has a negative PEG, and for NMDC it was in last 3 years the PEG has become poor. Let us look at the sales growth rate. of the company from past 5 years and how the sales has grown from past 3 years. Coal India's has managed to increase its sales over the period of 5 years at the rate of 13% and over a period of last 3 years at the rate of 20%, which is very good. Although that has not got translated into its profit, which is again gives it a poor score. When what we want to see is the sales also increasing as well as profits increasing along with it. That gives us a confidence that the company's sales are getting converted into profits. Let us look at the other companies. Vedanta sales have increased at an exceptionally high rate of 101% from 5 years back. Now, whenever we see such exaggerated values, we have to ignore that, or we have to at least look at what or from where this particular value has come. What was the base value and what is the current sales figure? So only when we look at it in that sense, then we understand the true meaning of this 101%. Generally, companies are able to increase their sales at the rate of maximum 20%, 30%, not more than that. So any value above that is a little dicey and needs to be looked into. Same goes for the profit growth rate. Whenever there is exceptional high growth rate in profit, then we have to look at the base price from where the calculation has taken place, how the profit has grown from the base price. NMDC's sales from last 5 years has grown at a very marginal rate of 1.65%. In fact, in the recent 3 years, the profit sales has fallen at the rate of 2%. Maithan Alloys has done a good sales growth rate for both 5 and 3 years. Indian Metals has managed to increase their sales in a single digit. So sales is a critical part of any company's financial statement, because this is from where the top line starts. If the company is not able to sell its products, its goods that it manufactures, then directly it affects the profit of the company. So this is a very critical ratio or number or a variable that investors need to look at in detail. So in terms of sales, Maithan Alloys again has done the best in managing to grow its sales at a high growth rate, and NMDC has done the worst at even in fact in the last 3 years the sales has dropped at the rate of 2% every year. Next, let us look at the return on equity ratio, RoE, of the last 5 years on average. That is, on the equity shareholders contribution, what has the company earned as profit, and the latest year's return on equity, that is 2018's RoE percentage. And then we'll also look at how that return on equity has grown from past 5 years. Coal India, let us analyze RoE for Coal India. This is the money that shareholders have contributed to the company and what the company is earning as profit on the shareholders' money. So since last 5 years on average, the company's RoE returns were 33%, which is excellent. Anything above 15% is very good. So the company is managing the shareholders' money very well and earning a very high returns on their contribution. Even the last year's RoE was 31%, which is very near to the average. So that's again a good sign. But from last 5 years or from past 5 years, the return that the company is earning has been falling at the rate of 4.12%. Although it is a negligible fall, since the return itself are very high, this can be ignored. Vedanta's RoE is very poor at 2.7 times from last 5 years on average, whereas the recent return on equity was 12.11%, which is still below 15%, so this is not a good sign. As investors, we want the company to earn a good return on our contribution or the money that we invest into the company. Again, here too, the return has been falling from past 5 years at the rate of 2.98%. So already the return ratios are very poor. Not only that, there has been a fall as well in the return ratios. As investors, what we want to see is above 15% figure for the last 5 years average, as well as for the recent return ratio that we have, and there should be a growth in the return on equity percentage. Let us look at NMDC. Both our ROE for average 5 years and the recent ROE are above 15%, but the rate has been falling again as in previous two companies at the rate of 8.38%. So this is a worrisome sign because eventually it will affect the ROE that the company earns in the future years. Maithan Alloys, as we can see, all the three are positive. As in the case of Indian Metals, all the three are positive. It's managed to grow its equity at the rate of 28%, and latest year it earned 40% return on its equity, and there's also a growth in that equity from 5 years at the rate of 18%. Indian Metals, if you notice, the 5 years average is 9.78%, which is way below 15%, but the recent ROE is 16%, and there's a growth in ROE at the rate of 16%. So the highest ROE on average earned was by Coal India at the rate of 33%. That is why the price to book value is also very high at 5.94 times. Last year's ROE, Maithan Alloys, was 40%, which was the highest in the group companies. And from last 5 years, the highest growth as well as in ROE was by Maithan Alloys. Next, let us look at the return on capital employed on average from 5 years and what the company has earned in the last year, that is 2018. Coal India's return on capital employed is very high at the rate of 50%, and last year it earned 45% return on the total capital employed into the business. Now this capital employed consists of the money contributed by the shareholders as well as the money borrowed by the company from banks and financial institutions. So a high return of 50% would of course give confidence to the investors to give higher multiple to the book value. Vedanta's return on capital employed is 16% in the last year, whereas on average it was earning just 7.5%. These are very poor numbers for Vedanta, where the RoCE is below 15%. All other companies, NMDC, Maithan Alloys, have done well to return above 15%. Indian Metals, last 5 years average is below 15%, which is not a good sign. So as far as RoCE is concerned, Coal India has done very well to give a very high returns or earn a very high profits on the total capital employed by the business. Vedanta has done poorly by returning a lower rate of return for the amount of capital that the company is investing. Now we need to ask a question: why is there a problem in the company? Why is it not able to earn good amount of returns for the capital that is employed into the business? Next, check the return on assets of the last 5 years on average. The assets includes all the assets of the company that has been put into the business by the company. This would include cash, investments, everything that the company has. In fact, we can say the balance sheet total, or the balance sheet size itself is the total asset size of the company. Coal India has earned 14% on whatever assets it had in the business. Vedanta has done very poorly at 1.3%. Indian Metals has done at only 4.2% on its total assets. NMDC has earned 15% and Maithan Alloys has earned 21%, the highest in the group. Let us look at the asset turnover ratio. This ratio measures how much times of the assets were the sales. What is the difference between the total assets employed by the business and how many times more were the sales against those assets? So this helps us understand how well the company is turning over or using its assets to generate sales. The more the better. Coal India has managed to turn its assets 6 times and the sales were 6 times higher than their assets. Vedanta's sales did not even exceed its assets. In fact, it fell below the asset that the company has. Same with NMDC at 0.47 times. Maithan Alloys managed to do double the sales of what it held as assets. Indian Metals again performed poorly and it didn't manage to sell as much assets it owned. NMDC was the lowest number in terms of converting their assets into sales, whereas Coal India managed to do sales of 6 times more than what it owned as assets. So this is what we would like to see, a higher number. Let us look at the next ratio. Here we will have to look at five ratios together, which is profit after tax of the last 5 years and how much of that profit has got converted into actual cash, that is cash flow from operations of the last 5 years, and out of that cash flow how much was free to be used for distribution, acquisition and so on. And then we will compare the cash flow with the profit, that is how much percentage of the profit was converted into cash and how much of the cash flow from operations was free to be used for the acquisition, dividend and so on. So let us look at the profit that the company has earned. Coal India's last 5 years profit was 59,380 CR. Of that, 79,783 got converted into cash. That is, it managed to increase its cash by more than 34% above its earnings, which is a good sign. Now let us look at the free cash flow. Free cash flow should not fall below 50% of the cash flow from operations. These are just general thumb rules that I follow. There is no hard and fast rule that if it follows it's a bad company. It's just for my understanding that how well the company is managing its free cash flow when compared to the cash flow from operations. So here the free cash flow has not fallen more than 40%, or I can say it has fallen only by 40% from its cash holdings, that is cash it received from operations. Vedanta, the cash flow has come in at the rate of 1000%. That is, if you see, the company has earned a profit of 7,500 CR, whereas the cash coming in is 89,000. These are aberrations, these are very high values. Generally, when we look at these kind of values, we should dig deep into the financial statement, look at the cash flow, why such a high amount of cash flow has come in and why is the company showing such a less profit. Let us look at the free cash flow. Even through the operations that it received, it had spent only 39% of that. That is 53,000 was still remaining as free cash flow. So this is a good sign, but here there's an exceptional gain or excess cash coming in when compared to its earnings. NMDC, the cash flow from operations compared to PAT is shortfall by 31%. Whenever we see these kind of shortfalls, we should be little wary about investing in such kind of companies. It is not a bad number as such, but we should, if the company is showing a profit, why it should not get converted into cash? That is the question that we need to ask. So out of 21,995 CR shown as profit or earnings in the last 5 years, only 15,104 has been received in cash. And out of that too, only free cash flow remaining is 7,426. That is around 50% is remaining with it as free cash flow. So now generally we would not want to see these kind of values in companies. Maithan Alloys was short by 13% from what it earned in operations, and the free cash flow was still intact at just 4.84%. That is, out of 545 CR in cash flow from operations, its free cash flow was still 519 CR, meaning it does not spend much of it in investment activity. Finally, moving on to Indian Metals, the cash flow to PAT ratio works out to 204%. So out of 448 CR as profit, 1366 was received in cash and 951 was still pending with the company as free cash flow to be used for distribution purpose. So that is only 30% is pending. 30% has been spent, rest it has with it as free cash flow. And 204% more than the cash flow from operations it received, more than the earnings it received in cash flow from operations. So in terms of CFO to PAT of the last 5 years, Indian Metals did the best by receiving 204 times more cash than what it earned as profit. Whereas free cash flow wise, Maithan Alloys did the best of keeping intact whatever it earned as free cash flow. But here too, we have to observe that in terms of CFO to PAT, it has not done well. It had a negative in fact, it had a shortfall in earnings which could not be converted to cash. So in that sense, this is not a very good ratio. We'll move on to the next ratios. In this, we have to compare average PAT with the last 12 months PAT, and then we'll compare the last year's PAT with the current PAT, profit after tax. And then again we have to compare the cash flow with the last year's cash flow with last year's profit after tax and see how much of the profit has got converted into cash. So let us look at all these ratios together. That is almost 7 ratios at one go. First, we'll look at the average PAT and then compare that with the latest profit after tax, whether that profit after tax was higher than the average or lower than the average. Here, it's a common sense that if a value is higher than the average, it means it's doing better. If it's below the average, it means it's doing less better or it's doing worse. So we can see this ratio which has already been calculated. That is, this year's profit after tax, 12 months profit after tax, was more than 47% of the average PAT. I stand corrected. The profit after tax of the last 12 months, we have to compare it with the average, whether it has gone above the 5 years average or gone below the 5 years average. So we see here that the last 12 months profit is 47% more than the average. So the average was 11,000 and the last 12 months it was 17,000. That is 47% more than the average PAT, which is a good sign. Next, we will compare how the profit has grown from the 2018 year to the latest 12-month quarter, that is from 18 to 19. In 1 year, how much has the profit grown? So the profit has grown by 149%. That is from 7,013 CR in 2018 to the latest 12 months, the profit has grown to 17,462 CR. That's a huge jump of 149%. These are very good values for Coal India, and that is why it has got such high valuations. Next, we'll look at the last year's, that is 2018's earnings. How much of that has got converted into cash? So we also see that is also very good. The conversion rate is 203%. That is, it earned 7,013 CR in earnings and it received cash of 21,262 CR. So this concludes for the Coal India. Let us look at the other companies' ratios. We will be concentrating on these three ratios, that is profit after tax of 12 months compared with how it worked with the average PAT of the 5 years. And then we'll look at from 2018 to 2019, how much was the increase in profit, or what was the profit growth in 1 year. And then we'll look at how much of the profit was converted to cash in 1 year. So the company's average profit of the last 12 months was up by 353% from its average, and its current year's profit was down by 9% from the previous year's profit, and it converted all of its earnings and 140% more than its earnings into cash. So these are good signs, except that the last year's profit was even higher than this year's profit. If you see here, in 2018 it had earned a profit of 7,511 CR, whereas in the last 12 months the profit was just 6,833. That is a fall of around 9%. Let us look at the NMDC's ratios. The company's 12 months profit is above the average by 5.53%, and the profit has grown from the previous year by 25.6%, which is again a good sign. And it is short by 8%. That is, out of whatever profit it earned in 2018, it could not collect all of it and it fell short by 8.5%. This is not a good sign. Maithan Alloys, 101% above the average profit in the last 12 months, and the growth, there is a decrease in profit at 13% from the previous year, and it could not convert 3% of its earnings into cash. It fell short by 3.2%, which is a marginal amount, but we expect that the companies should convert all of its earnings into profit and more of it if there is a depreciation involved or a high credit sales involved, and so on. Finally, Indian Metals, the profit was up by only 1.3% above its average, and the profit has fallen from the previous year by 49%, the highest fall in profit in the group companies. But it converted more than its earnings into cash by 66%. So when comparing 12 months profit with the average of the last 5 years, Vedanta earned the highest profit above the average, and Indian Metals earned the lowest profit in the last 12 months when compared to the average. When comparing the profit of the last 12 months with its previous year, we saw a gain, highest gain in Coal India at 149%, and Indian Metals profit fell the highest by 50%. As far as conversion of profit into cash, Coal India converted its profit and cash by 203%, whereas the lowest conversion rate, in fact, NMDC could not convert 8.5% of its earnings into cash. Let us move on to the quarterly sales data and profit growth rates. First, we'll look at year-on-year growth rates in sales and profit, and then we'll work on to the quarter-over-quarter comparison of profits and sales. So YOY, there was a growth in sales of Coal India by 7%. That is, from the previous quarter of March 18 to March 19 quarter, there was a growth of 7.5%. The highest degrowth was in Vedanta at 15%. Other companies also had a mild degrowth, NMDC and Indian Metals. The profit growth rate for Coal India from its previous quarter was 362% higher. Maithan Alloys had a degrowth in profit, or profit decreased by 21% over its previous quarter. Looking at the quarter-on-quarter comparison, that is from December quarter of 2018 to March 2019 quarter, we see that the sales have increased by 13% for Coal India, and Vedanta and NMDC had a negative sales, or had a fall in sales at the rate of minus 0.8 and minus 0.1%. These are low values, but we would want to see a positive growth rates in sales as well as in profit. Profit-wise, Coal India had a good profit growth rate of 31%. Vedanta had a profit growth rate of 66%. Now, whenever we see such type of growth rates, we always need to go and check why and ask questions why there is such a high growth rate. Indian Metals had a degrowth in profit, or profit fell down by 313% from its previous year's quarter. That is, from December quarter it fell by 313%. This needs to be inspected as to why there was a fall. So if we have to analyze YOY sales growth, Maithan Alloys had the highest sales growth over its previous quarter, whereas profit-wise, Coal India managed to gain the highest profit growth rate, YOY. In QOQ profit growth rate, Vedanta did the best at 66% growth rate, and the worst was Indian Metals, whose profit fell by 313%. Sales growth rate, Q over Q, that is quarter over quarter, the best performing stock was Maithan Alloys at 15% growth rate in sales over its previous quarter, and the worst performing was Vedanta at a fall in sales at the rate of 0.85%. Let us look at the next ratios, net worth and contingent liability. These three ratios we'll look at one go. Basically what we are doing is we are comparing the contingent liability against the net worth of the company. Net worth is the actual value of the company if the company pays off all its liability, whatever remains is the net worth of the company, or the actual worth of the company. Now, contingent liability are those liabilities for which the company has not made any provisions in the financial statements or the profit and loss statement or the balance sheet. So these liabilities can arise in the future, for which we need to be careful that it does not exceed a certain percentage of the net worth. In this case, I would like it to be below 20% of the net worth. Coal India's contingent liability was very high, more than 297% of its net worth. Its net worth was 26,000 CR, whereas its contingent liability itself is 78,000 CR. which is way too high than the net worth. Even if we expect 20 or 30% of this to be converted to actual liability, then it wipes out the entire net worth of the company. As I suggested, the contingent liability to net worth should be less than 20%. Vedanta's contingent liability is also very high at 63% of its net worth. NMDC has a very low contingent liability to net worth ratio of just 12%. Maithan Alloys was just 6% and IMFA was just 14% of its net worth. So in terms of net worth, Vedanta is the largest company in the group when looking at the pure net worth. Whereas Coal India's net worth is just 26,000 CR. But its market cap is higher than Vedanta's because investors give it a very high premium. In terms of contingent liability, Coal India's contingent liability is the highest. In fact, 2.9 times more than its net worth. Whereas the lowest contingent liability is of Maithan Alloys at just 6% of its net worth. Next, we'll look at the debt to equity ratio and then compare that with the interest coverage. And also we'll look at how much was the profit earned on the debt, or what was the difference between the debt and the profit. So let us start with the debt to equity ratio. The debt to equity ratio should not exceed more than 1 times. That is, debt should not be more than 1 times of its equity contribution. That is the contribution done by the shareholders of the company. In most of the companies, the debt seems to be below 1 times. Vedanta's debt is the highest at 0.93 times, and both NMDC and Maithan Alloys has done the best at 0.01%. Next to nothing, next to negligible, there is no debt at all. Interest coverage, we want as high as possible, more than 4 times. This number represents the number of years that this year's net profit, that the current year's net profit can cover the interest payments of the future years, even if in the future years the company doesn't make any profits. So in this case, Coal India's coverage is quite high at 99 years. What it means is that this year's profit, that the latest year's profit that we have available, can cover the next 99 years of interest payments. Vedanta's debt is very high at 0.93. That is why its coverage has fallen below 4 times, and it can hardly cover 3.2 years of future interest payments with this year's net profit. If you look at Indian Metals, the debt to equity is 0.58. Even then, its interest coverage is so low at 2.32 years. That is because in the latest year it has suffered, in fact its profit has fallen at a very high pace from its past or from its previous year. Next is the debt to profit. This particular ratio helps us understand where or how much was the debt when compared to the profit. So in this way we understand, is the company earning good amount of profit when compared to the debt it has taken up. So in this case, the profit that the company earned last year, the debt was 0.3 times of that. That was 1/3 of the profit was the debt. So whatever profit it earned, 1/3 of that profit was the borrowings that the company had done. In Vedanta, the profit was not enough. In fact, profit has fallen, or profit is way too less than the borrowings that the company has taken. So the borrowings is 5.5 times higher than the profits. So it is not sufficient to cover the borrowings. Here we want to see a value as low as possible. NMDC had a borrowing of just 0.1 or 1/10 of its profit. Maithan Alloys' debt is next to negligible against its profit, and Indian Metals' borrowings are 3.6 times higher than the last year's profit. In this way, we basically understand where is the borrowing and how much was the profit against that, or is that borrowing sustainable? Is the profit able to cover that borrowings? Will the company be able to pay off the debt easily with the profit that the company is earning? Both NMDC and Maithan Alloys have managed to keep their debt below 0.01. The highest debt was of Vedanta, because of which its coverage fell to 3.29 years. The worst in this case was Indian Metals at only a coverage of 2.32 years, and the highest coverage was of NMDC at 179 years. In terms of debt to profit, meaning what was the debt as a percentage of profit, the best in the lot was Maithan Alloys, having the lowest debt. Therefore, maximum profit was there when compared to debt. And the highest or the worst ratio in terms of debt to profit was of Vedanta. The debt was 5.58 times of last year's profit. Let us check the next ratio: change in promoter holding, the promoter holdings, and the pledge percentage. These three ratios we'll look at together. This ratio shows, the first ratio, that is the change in promoter holding, shows how has the promoter's holdings, shareholding has changed from 3 years back. So we see in Coal India, the promoter's stake has reduced by 1.95%. That's a marginal drop from where it was 3 years back. There was no change in Vedanta's shareholding as well as Maithan Alloys and Indian Metals shareholdings. NMDC's shareholding fell by minus 0.15, so that's hardly anything. So I won't give any ranking here as such. Let us look at the current promoter holding of the companies. Coal India's promoters hold 70%, mostly controlled by the government. Vedanta is at 50%, and most of the companies are above 50%. Let us look at the pledge. None of the companies have done any pledge of their shares. So this is a good sign. We don't want the company's promoters to pledge any of their shares. I won't give ranking to any of these three because most of the ratios are under a common category or common value. Next, let's look at the debtors to sales percentage, and then debtor days and debtor days 3 years back. These three ratios together help us understand. First ratio tells us what was the amount of debtors yet to be collected against this year's sales, or how much money was still pending to be collected from the customers against this year's sales. Coal India's debtors to sales percentage was just 5.51 times or 5.51 percentage, which means debtors were just, or accounts receivable were just 5.5% of the total sales. Most of the companies have managed their debtors to sales percentage very well. Here we don't want the debtors to exceed 30% of this year's sales. Most of the companies have managed to keep their debtors below 10%. It means they're collecting the money efficiently from the customers. Now let us look at how many days, or within how many days the companies were giving the customers to pay them or collecting payment from the customers. Most of the companies have done well. Coal India was taking 24 days to collect payment from the customers. The highest was NMDC and Maithan Alloys, taking almost 46 and 47 days to collect payment from the customers. We want to see as low as possible. The criteria for me is less than 90 days, which most of the companies have managed to keep it below that. 3 years back, the ratios were quite different in the collection period. NMDC was taking 51 days, which they reduced to 46 days in the recent year. Maithan Alloys collection period has also fallen from 77 to 47. For both the debtors to sales percentage and debtor days, Indian Metal seems to have done the best, having the lowest debtors collection and collecting the payment at the fastest number of days. Maithan Alloys seems to having a high debtors against its sales in the peer group companies, and also it's taking more days to collect payment from its customers. For the debtor days of 3 years back, I'm not giving any marking here. Next, let us look at the inventory turnover, that is, how well the company is churning over its inventory into sales. Coal India is converting whatever inventory it held at the end of the year 15 times more into sales. That is, sales was 15 times more than the inventory holding of the latest year. Vedanta managed 8.5 times the turnover of the inventory. Here, what we want to see is a high turnover. That is, the sales should be as big as possible than what inventory the company is holding. Inventory should be as low as possible and the sales should be as high as possible. So we have a high inventory turnover. We'll look at the historical 3 years back inventory turnover ratio. 3 years back also, Coal India was doing 13 times its inventory. That is, sales was 13 times more than its inventory. And most other companies have managed to increase it to a little higher turnover from where it was 3 years back. This is what we would want to see as to how the company is doing from 3 years back. Similar is for the debtor days. Where it was 3 years back, it needs to increase or speed up its collection cycle or collection days. So in terms of inventory turnover, NMDC seems to have maximum inventory turnover into sales, whereas the lowest turnover rate was of Indian Metals, where it just managed to convert 4.6 times its inventory into sales. This ratio in itself does not make much sense, because if the inventory holding is very less, then also the ratio will shoot up high. So as such, we should not be giving it a ranking, because this ratio can get changed very easily by just tweaking the inventory holding value of the company. Next, let's look at the 5 years operating profit margin. How the company performed in the last 5 years. What was the average top line margin that the company earned before we included the interest, depreciation and tax rates. The highest operating profit margin was by NMDC at 53% since last 5 years. In terms of last 5 years operating profit margin, NMDC has done the best by growing its OPM at the rate of 53%. Again, this itself does not show us anything, because there are other expenses like depreciation, interest, cost, taxes, which needs to be deducted from this operating profit. So finally, what is the net profit margin that the company is earning? That also is very important. So as we saw, NMDC has done the best in terms of earning the highest OPM in the last 5 years on average. Maithan Alloys has done the worst, or has done the least in terms of earning OPM at the rate of only 14.95%. Here, as investors, we would want to see at least a 15% of OPM percentage or OPM margin. Next, let us look at the net profit margin that the company has earned in the last year. The highest net profit margin was again by NMDC at 32%, and even in the previous year to that, they had earned a net profit margin of 29%. Coal India's NPM has fallen to 5.45%, which is very low, and in the previous year it was 8.02, the lowest of the lot. I'll not give any ranking to the net profit margin of the previous year because we have already given ranking to the last year's NPM percentage. In that sense, NMDC has done the best and Coal India's NPM has fallen below 10%. In fact, it's very low at 5.45%. The other reason why the NPM is so low is because the company operates at a very high sales leverage. That is, it has a very high sales, and against that it cannot earn a very hefty profit margin. That is why as the companies grow, the profit margins shrink because they are mostly doing volume trading. Next, let's look at the current ratio. The current ratio is basically calculated to understand whether the company's current assets are enough to cover the current liabilities. The current assets and current liabilities are those assets and liabilities which have to or which can be sold off as in case of assets or has to be paid in terms of liabilities. So can this year's liabilities be easily covered by the assets that the company owns? So here what we want to see is that we have or the company has more current assets than its current liabilities. That is, its coverage is all its liabilities can easily be paid off within this year by selling all the current assets. This is a quick liquidity ratio that is used to understand how liquid the company is. Here we want a higher coverage as far as possible, not a very high coverage but a reasonable coverage of 1 to 2 times at least. Coal India has enough assets to cover its liability by 1.5 times more. Vedanta's assets are not enough to cover its current liabilities. It's falling short by 0.78%. NMDC, Maithan Alloys, even in India Metals have done well in keeping their current ratio above 1 times. As in quick ratio, here we only consider those assets which can be quickly sold and converted to cash. One of that is inventory or cash and bank balance or fixed deposits and so on. Investments, those can be easily converted into cash. So this ratio is a part of the current ratio, but in the sense that it does not consider all current assets. It only considers those assets which are quickly or can be quickly converted to cash. So for the quick ratio, we see NMDC and Maithan Alloys still has a very high quick ratio percentage or ratio, and Vedanta as well as Indian Metals have less quick ratio coverage. They'll fall short if the liabilities arise. They won't be able to pay it off immediately using the assets which are easily convertible to cash. Again, in terms of current ratio and quick ratio, Maithan Alloys seems to be having the highest amount of assets to pay off all its current liabilities, whereas Vedanta has the least amount of assets. In fact, it has less assets than what liabilities it has taken up. Next, two ratios are Petrosky score as well as dividend yield percentage. Now this Petrosky score is a score made up from 1 to 9, where 9 is the highest value that can be given to a company. It basically considers multiple criterias which one can go and check out on the web or Google it out what the Petrosky score actually does. Basically it checks how a company has done in terms of few ratios, almost say 6-7 ratios or even more than that, and comparing it with the previous year's value, and if it's more than that, it is given a score of 1. If not, no score is given. So in that sense, we will not give any value here to the Petrosky score. This is just to understand what that is. and the value given here may not be correct also. So I'm not giving any ranking here. Finally, let us look at the dividend yield percentage. What is the dividend paid by these companies to its shareholders for the investment that they have done? All of these companies are high dividend yield companies which are paying 6%. Coal India is paying 6.5% as dividend on the current price when calculated at the current price, and with the last dividend value that we have, Vedanta's dividend yield works out at a very high 12.5%. So if someone is buying today at this current price, then the dividend that was paid last year, assuming the same would be paid this year too, they would be getting a return of 12.5% on their investment, which will be considered a very high dividend yield. The least dividend paying company is Maithan Alloys at 0.49%. Here also I won't give any score to the dividend yield, as some companies may pay more, some companies may pay less. This is just a bonus that a shareholder can expect, and I have included this in the analysis so that we have an understanding whether a company is a dividend paying company and how much dividend it is paying to the shareholders. Finally, our analysis is complete. Let us look at the score the companies have got. Maithan Alloy has got the highest points of 126, followed by Coal India at 84 points and Vedanta at 78 points. Both NMDC and Indian Metals have fallen behind at 70 and 53 points. Even after getting such a high score, we still need to look at whether the stock is at a reasonable level to enter into. Now, why this is so important, that even after looking at the best company, if it's high, for example, the scrip has fallen down only 13% from its 52 weeks high. As we saw earlier when we started the discussion, the lower the fall, the better the company, the stronger the company is. That is, investors are not willing to sell the stocks. The more the fall, the more problems the company may be having in the fundamentals. So here, what we understand from the total score is that not only the score has to be high, that the fundamentals have to be good, but also the price has to be low. So for me, I enter at a technical level. I look at the charts. Of course, this is a lot of work, but there is no substitute to hard work. You have to devote time. 2 hours or 3 hours maximum is enough to understand and analyze a company using a simple website called screener.in and putting these ratios in and then cross comparing it. But we need to work on that, and as investors we need to take out time, devote time, look at the company, how the company's sales are progressing, what is its liquidity position, what is its profitability position, what is its valuations, and so on. These things we'll need to learn slowly as we progress. I too have learned it one ratio at a time, and this is the scoring system that is not foolproof, I understand, but in a way it helps me understand what or at what point which company can be bought into and which is the best company of the lot in terms of looking at different ratios of 5 years, 3 years, and so on. Now, as for the technical part, I look at the weekly RSI level to be below 30 line. It's a technical term which I cannot discuss. This particular RSI charting I cannot discuss in this video, as this is beyond the scope of this video. This video is basically for fundamental analysis of the company, which is very important. If it doesn't match the criteria of the fundamental, if the fundamental ratios are not good, then I don't look at even the RSI, where the RSI level is. I hope this video would be helpful to you. Thanks for watching.